Well, hey there, Southern Oregon. Welcome back to the Real Estate Show. We're so glad you could join us today. We've got a great show. We have the team from Mutual Mortgage here with us, and they're going to help us dissect and unpack all the financial stuff that happened this week. And we had another announcement by the Federal Reserve Bank. They announced they're raising the rate 0.25%, which is a little more relaxed than we've had of recent, but it was still an increase. But all these changes that are happening affect mortgages, buyers, sellers. It affects what's going on here in our Southern Oregon market. But I also want to say this was a busy week for buyers. We had a lot more buyers get pre-qualified. We had a lot more buyers jump in and start searching. We had a couple of multiple offer situations. We don't have very many of those anymore, but we had one in Jacksonville and one in East Medford. And so when Mutual Mortgage comes on in just a couple minutes, we'll bring them in. We've got Giles Beth Rodriguez and Ronchetti, all from Mutual Mortgage today. Let's take a quick second and talk about our local Southern Oregon stats. Now, next week, we'll have our SOMLS, our Southern Oregon MLS, and Rogue Valley Association of Realtors stats. They come out every month, but it comes out a little later. So we'll talk about that next week. But here we go for our residential market. Let's talk about how many new listings we do or don't have. Klamath Falls is still down 9% in new listings from this time last year. Josephine County is dead even. Isn't that interesting? Josephine County has the same number of new listings as it did this time last year. And then Jackson County is down 9%. Now our prices are still up. Klamath Falls is up 8%. Josephine County is up 5%. Jackson County is up 5%. So we're still down in the listing department, but we just had a bunch of buyers enter the market this week. Our prices are still up from the year before. So far, no crash, not whoop. And also, we have the spring selling season. We've got a lot more listings coming up. We've got a lot more tours. We've got open houses again. So we're looking forward to a great spring market here in Southern Oregon. So with that said, let's take a quick break from our sponsors. We're gratefully brought to you by John L. Scott, Ashland, Medford, the local Rogue Valley Association Realtors, and Giles Mutual Mortgage. We'll be right back with the team from Mutual Mortgage. It's going to be a great show. Don't go away. Well, hey, Southern Oregon, welcome back to the Real Estate Show. I'm Alice Lema. I'm your host of the show. I'm a broker here in beautiful Southern Oregon with John L. Scott Real Estate. And today we're so excited to welcome back Giles Beth Rodriguez, and they brought along Ronchetti, all from Mutual Mortgage. Welcome, everybody.
Hey, thank you very much.
Morning.
I know it looks like it's spelled Ronchetti, but I think he pronounces it Ronchetti.
Sorry, Mr. Ronchetti. He's
my boss, so I figured I'd have to back him up on this.
Right better. So welcome, everybody. We had a really big financial week. Who wants to kick it off?
Well, I mean, I could say a thing or two. I mean, we finally have Powell, talking about from the Fed, saying that inflation is actually starting to go down, which is a little change from the language. I mean, people watch what the Fed does, but the biggest thing about it is what language do they use. So that was a little encouraging. And I think we, going forward, we did get a 1/4 point raise this week again. So, they've literally raised this thing, since the beginning, about 4.5%. And we're probably looking, for the next couple of months, for March and May, for maybe two more rate hikes. And hopefully that'll be the end of that. Maybe you can get a little bit of relief on your credit cards or something. But
so what does that mean exactly when you say it's how they word it? What does that mean exactly to the average person?
Sometimes it's a little difficult to you just kind of have to read between the lines in what they're saying. Investors live and die by this stuff. If rates are going to be high, there's certain times you're making money in the markets, and there's certain times you want to be in some safer things like bonds and treasuries, and if they allude to the fact that, hey, inflation is terrible and it's just going to get worse and worse and worse, and we raised it up 3/4 of a point, it's a little bit of a different story, that now they're taking their foot off the gas for the first thing. And that's something that's obviously not said. You just see that in how much they do it. But he literally kind of used the language that they are seeing some things ease. Unfortunately, the core cost of shelter was not one of those things that they're really seeing yet, but the cost of goods are coming down. Some of the fuel's coming down. We can't, obviously, we don't know for sure what the government does, so they could, that could affect something separate from the Fed. I won't say anything about them good or bad, but beyond that, if everybody just kind of leaves everything alone, we should be looking at this inflation, which has not been fun for anybody, really easing over the next few months. And that'll translate in our direct world to some lower rates, but they'll just throw out little tidbits during their speech. And honestly, it was different 2 years ago, even 2 years ago, 3 years ago, you didn't really know what the Fed was going to say. And now they have a little bit of a different system where they like to kind of leak things out, so people kind of know what's going to happen before it does. So it's a little different dynamic these days, but we're still, we just kind of look at what they're actually doing, try to read between the lines with some of the verbiage that they use. And that was probably way too long of an explanation for that.
It really comes down to just that. To sum up, Guy, it's really about the verbiage and the speculation is what the future speculation is going to be. And everybody knows that they were going to raise rates. The question was going to be, how many more times are they going to raise it? And that's going to really come down to inflation. And all indicators right now is that we should see the CPI that everybody hears about, was Consumer Price Index, and the PPI, the producers, what's in those numbers going to be coming out here over the next week. And a year ago is when they were spiking. So the speculation is we're going to see continued easing, and the language is basically bearing that. And of course, we also had some news today, specifically from the European banks, effectively saying the same thing. So it's all good news coming from, that global economy that we've kind of shifted into now.
So, Michael, you are the regional vice president, and you have kind of a big area that you're servicing, taking care of right now. What kind of side effects have you seen in the last 6 months from your perspective as the regional vice president of a lending company?
There's it's vast. I mean, because it really does go down to market. We've seen a shift from the urban areas, the cities, as they say, to the rural areas and the suburbs. People have been pushing out. A lot of that dynamic has been through technology and the ability to work remotes, and some of that's the aftermath of the pandemic. Also, the aftermath of a higher rate. People are moving to affordability, and the suburbs are more affordable. We're seeing more movement from even certain higher end states to lower cost of living states. So we're seeing some big shifts there. That's a lot of the activity. But I do think as rates can, come down, affordability picks up, more people can enter the markets. We'll start seeing those, the urban areas, some of the higher cost areas traditionally start rebounding in the coming months. But for sure, over the last 6 months, through this whole rate push higher, that's really been, the dynamics that we've seen, most on the macro level, is just where the shifts, where the purchase markets have been happening, and where the price increases have still been going up, while certain markets, obviously Seattle as a whole, has been going down due to that.
So this will be interesting, because we're all used to when there is inflation. A lot of us are old enough to remember the 70s and 80s, that people do move out to the outskirts because it is more affordable, and they move back in to the urban areas. But with the permanent remote working phenomena, what do you think What do you think is going to happen to our bigger urban areas? Do you really think they'll come back?
There's always going to be an appetite for, some of the areas like Lake Oswego, if you took in Oregon and around Portland, that's always going to have a demand. It might fluctuate through this time, but there's always an appeal to be in that area. Same thing if I'm in the Seattle marketplace, if you're in Green Lake or some of those areas. However, some of the other areas, some of the folks that maybe live downtown in that 700 square foot rental studio that they're paying $3,000 a month for, that individual's probably not going to head back anytime soon. They're probably relishing the fact that they have a yard
and a pool,
for probably still less money. And so you're going to see those parts of the city, the city proper, if you will, the Portland metro and Seattle metro. You're going to see it's going to be tough for those areas. I think even in the long term, there's probably not going to be a whole lot of appeal to run back into that environment. Plus other geopolitical situations going on that you find yourself. So
then there's that.
Yeah, it's going to be interesting to see how the cities find their way back outside of the areas like a Bellevue, like a Kirkland up in Seattle, to Lake Oswego and so forth.
Mm-hmm. So Guy and I every month talk about how the numbers don't point to any kind of huge crash, at least for us. What are you seeing for 2023? Just because you have a much bigger perspective, you're managing a much bigger area.
Well, and I think Guy's dead on in especially in the greater Medford. If you wanted to say Southern Oregon, I think Southern Oregon always has an appeal. It has an appeal not just for the folks in the city areas, but it has an appeal also for California and folks in the city areas of Northern California, specifically the San Francisco, Sacramento areas, looking for affordability and getting out and looking for blue skies and so on. So you will always have an appeal to Southern Oregon, and in those marketplaces, I think we'll continue to do well. Our biggest opportunity is still going to be inventory, and I think we had a buyer's market to a degree over the last few months, but that was more because of rates, and there was less affordability, so there's less buyers. So it wasn't, now as rates start to come down, and this is what we're kind of telling our looky-loos that we pre-qualified is, now's the time to get out there and make those offers, because as rates come down, this is where it's going to turn back into the sellers. We're going to get the multiple biddings. We are already seeing that in some marketplaces.
Are you really? You're
Yes.
seeing multiple offers again?
We're starting to see some multiple offers, not in everywhere, but typically, the first stone is cast, the wave goes from there. And so that action is starting to happen. And as, the word gets out in the street, I think it's going to then, get out there, especially maybe, again, not so much maybe in the urban, but in those suburban areas. But then again, traditionally, we're starting to head into that purchase season where we start seeing more listings coming on and so forth. And honestly, it might be a good thing that we start seeing the multiple offers, because that's going to prompt sellers to say, hey, okay, things are going our way again, and I better get my house listed.
But don't add another zero to it, please.
Right, exactly.
Because that's what they all want to do.
No, we still have to, and they're still going to be, because as we all know too, I think appraisers and different valuations are also taking a lot more look at valuations in the area. But it's definitely going to be, so this upcoming year, it's not going to be, in my opinion, it's not going to be a record year, but it will, I do think that we will see an uptick over what we've seen for sure over the last 6 months. And, it will open up, and it will create a seller's market again, and look for more inventory to be hitting the market.
Interesting. So, Beth, how's your business going? Are you seeing an uptick in pre-approvals, or are people kind of coming back to life now?
Yeah, we definitely are. Last night was kind of a late night just because we got some in late afternoon and, having to work on that. So definitely seeing an uptick in the leads and pre-approvals. We stayed, we've had some slow moments, but stayed pretty steady in the leads for December and January. So I think February is going to be even yet a bigger, month in leads for us.
Yeah, we're starting to see a little bit better quality leads. I don't know if people just think that the housing market's going to crash, or somebody heard on the radio that maybe rates are coming down a little bit, but we've got some stuff come out of the woodwork in the last 2 months, and we're just really trying to, come up with solutions for people. Actually, I'm trying to help a guy right now. I'm not trying, we're going to help him with this down payment assistance program. Maybe we can talk about that a little after the break, but where their only options were USDA or, really this other lender didn't have a lot in the way of options. So, that, just getting a little bit creative with some of these people, a little bit lower FICO scores, a little bit less down payments. And like I said, we're starting to see some more people that are a little bit more ready to buy, but we've been getting some good practice at the weird lately. So
Yeah. Well, everybody should talk to a lender, and even if you can't manage, Guy and Beth and Michael will help you get ready. So it's time well spent. We're talking to Mutual Mortgage today, Guy Giles, Beth Rodriguez, and Michael Ronchetti. Just want to say we're going to have to take a quick break here because we are brought to you by Mutual Mortgage. Thank you very much. We're also brought to you by our local Rogue Valley Association of Realtors and John L. Scott, Ashland, Medford. Thank you all. We appreciate you bringing the show every week. We'll be back after a quick word. Well, hey, everybody. Welcome back to the Real Estate Show. We're talking to Guy Giles, Beth Rodriguez, and Michael Ronchetti, all from Mutual Mortgage. Before the break, Guy, you happened to mention down payment assistance. Let's talk about that because that sounded intriguing.
Yeah, we've been doing them around here for a little while, but really what we have is a second mortgage. And a first, but Mike, actually, I'd really rather have you probably explain this one a little bit. It's a program that I'm literally diving into for the first time today. It doesn't look super difficult, but I think you'd probably be a little bit more familiar with the guidelines on it.
No, absolutely. The one great thing about the down payment assistance, we had seen them kind of dissipate, not be used a lot, especially over the prior 2 years. A lot of it with the market shifts, a lot of it with affordability factors, and then also just in the escalating markets that we had seen, especially 2 years ago. Folks, sellers were calling their shots. We've seen down payment assistance now come back into the market, especially recently, and it's allowed to bring in more buyers, especially the millennials and even the older Gen Zs. That are coming in, and quite honestly, 40% of the purchases that are going to be happening through this year are going to be millennials. And having these products and programs out there at their disposal to bring in more is going to be crucial. And we have a great product that is out. There's a lot of different DPAs. There's everything from state bond programs. Oregon has a state bond program as well as Washington and several other states. The only opportunity within those programs are your credit scores. Some of them have a more conservative credit score, or your debt to income, which is how much you make, as opposed to what debt you have going out, and they're more restrictive. We have a product now that's out that's really great for the market. It's really going to be great for Southern Oregon specifically, where the debt to income requirements are far higher than the state programs. And at the same time, with the loan to values, going to 96.5, but then doing, as Guy mentioned, a second behind that, which allows to go actually up over the 100% mark and being able to finance even some of the closing costs. So it gives individuals, especially if there's some seller credit, which we're starting to see creep back into the market right now for sellers that are aggressively marketing their homes, that, in theory, someone could come in with a pen. We haven't seen that in some time in the marketplace. So that's why I said some of the dynamics with some of the products that are coming back in. And a lot of that has to do with speculation on, maybe we've hit that flat mark in certain areas that have declined, and in other areas are still seeing an increase. It's a good sign to see these type of programs coming back out, because it just shows where we're going in the future, not to mention allows more people to afford a home.
Well, and it's also a nice thing that you're not, historically, we've had people come in from Access or different places that are offering some kind of help for down payment, and then the money runs out, and you're not dealing with the bureaucracies of the state. You're really dealing with somebody that just does this for a living. I mean, I just had Mike speak on it because, again, I'm just going through some of the training right now, but everything I'm looking at on it is basically just like doing a regular loan. And again, it's just regular underwriting standards. By the way, we're not going back when you hear 100% financing. We're not talking about negative amortization loans. We're not talking about, that we're still fully underwriting these people and they're vetted out.
Yeah, you have to qualify for this.
Right.
Yeah.
Yeah.
We're not reliving the 2000s. Yeah.
But running the numbers up against even a USDA loan on this, so far that I've done this morning on this one that I'm putting together, purchasing power is just going to be a lot better. Just what he said earlier, the DTI, or the debt to income ratios, are a lot lower on the USDA program, and you can't buy everywhere. As we grow, we've ruled out, Central Point and Grants Pass in the last few years, just because, it really is a program that's designed for rural communities. And, so yeah, are you really going to go get a USDA in Ashland, even though you can with the pricing there? Then you're going to make too much money for the program. So it's a good program in some places, but I'm pretty excited about this new DPA program. And by Monday, you can call me and ask me any questions on it, because I will be all trained up.
You will be well versed.
So on the down payment assistance, sorry, I'm getting ahead of myself. Is that a conventional loan, or is that FHA, or what is that? What kind of program is that?
That is running as a FHA program. So it's because what we're doing is we're utilizing the guidelines within FHA for that down payment component, that second. And historically, that is what most of your down payment assistance programs run under, just because of some of the conventional guidelines around it.
Okay. And so if it's an FHA type in that family, then is the minimum down payment also 3.5%, or do you have different?
Well, yeah, but the second mortgage acts as the gift.
Right. But I just didn't know where the lines were.
Oh yeah. No, yeah. Still 96.5 on that first mortgage.
Okay.
And putting everything together and pricing it all out. But to Guy's point, and it's a really great point, is one, from a pricing standpoint, it's very competitive. And quite frankly, when you do look at USDA as some other options, there's, some of these other programs are so restrictive, or you're waiting, are they running out of money today? Is my income too high? And of course, even with USDA, their income requirements are based upon what you're making today, not necessarily what the income is you're qualifying under. And it starts throwing people into loops with all the advanced mathematics on how everything's going to be compiled.
Well, in Southern Oregon, it's a little even more challenging to have a USDA buyer, only because, if I remember correctly, they don't do double wide manufacture, triple wide manufacture on land, and we just have so much of that. It's how many of our residents get to live in the country, is because they have that kind of construction.
Yeah, there's one or two ways that you could work with those, but it's very restrictive as far as the manufactured houses. The other problem is, if an appraiser goes out, because we are a little bit more rural, and usually that's where the manufactured house is going to be, out on some land. If you have a barn there and the appraiser gave $20,000 value to that barn, the USDA is going to back that right out of the appraisal. So I literally had a house appraised.
I did not know that.
Barn. Yes, I ended up finding him another house, and we're still friends, but back when I was first doing it. Yeah, we got completely sabotaged by an outbuilding of all things.
Wow.
And it was in great shape, but USDA sounds like it's going to be this really good rural land, but it's really more for keeping small towns alive than it is for, you know, real rural properties where you're going to be.
Well, and I think the pandemic and the remote work and the flee from the urban area is keeping all the small towns alive. So now maybe we're going to have to figure out how to keep our inner city, our urban areas alive. But that would be a different radio show than today. We're talking to Giles Beth Rodriguez and Michael Ronchetti, all from Mutual Mortgage. We're talking about down payment assistance, Southern Oregon, the economy, and we were going to talk a little bit about some construction. So that's an interesting question, just to follow up on the down payment assistance that Mutual Mortgage offers. Can that be used in some kind of a rehabilitation, renovation situation?
We on that, we do offer renovation loans, so that would be different from the construction program. You mentioned a little bit about manufactured homes, and I do think that they're, you know, from an affordable housing throughout the country as a whole, manufactured homes are going to be picking up a big slack of the affordable housing, especially as people move from the urban areas, driving up prices and so forth on other homes. And the construction program does cover people that are buying manufactured homes and looking to put those on land.
Oh, super cool.
And, you know, and that's actually a great program for that. And you have the ability to effectively buy a manufactured home, put it on land for 3.5% down, utilizing FHA. And, you know, we do have conventional outs. So it's not just about building a stick-built home, but also going and buying a manufactured home and putting it on land. And I really do think in this time right now that we're in, that's going to be a huge program going forward for consumers.
And I think that in Oregon, because Oregon is so on the front of the progressive energy movement, because manufactured homes are highly energy efficient.
Absolutely.
Super energy efficient. So yeah. So Guy, I interrupted you. Sorry.
Oh. No, it's funny, an email popped up and I might have lost my train of thought. But as far as just the manufactured houses, you know, I mean, I lived in one when I first got married, and it was still had axles on it, and it was nothing like what you're describing, you know, today. If you tried to put my stick built house on a trailer and ride it down the road, the thing would fall apart before I hit the highway. And these things are built really, really well. But as far as the construction piece of the thing, you know, you're going to go in and you're going to get the builder and you're going to get all of your items together. But, you know, they thought it through really well, where you can still finance it separately, because that guy's not necessarily, or gal that you hired to be the contractor isn't necessarily going to do wells and septics. So it does allow for you to finance in the wells and the septics as part of the whole thing, you know, and you would obviously have, you know, a different contractor for that. And, you know, so, I mean, it is a really well thought through program that I'm really excited. I got 3 of them that I've started up really in the last week, where we're just getting them started up right now.
Now, are you talking about financing a brand new manufactured on land? Or are you talking about construction?
Well, I'm talking about both.
Okay.
Where, you know, a lot of times somebody will want you to have your well and septic on there or own the property. With this program, you can purchase the property.
Oh, I see what you're saying. See what you're saying.
Yeah. So, I mean, it's pretty ready, you know, pretty ready to go. But I guess what I was talking about was just on some of these other things, you are able to finance those into the construction loan, and it's not something that has to be done separately. And lastly, I know we're coming up on the break. It's not a interest only loan, or, you know, something that you have to worry about. It is a true one-time close where you know your rate and you know everything going into it at first. So that's a huge bonus.
That is because not all lenders do that. And then you get kind of surprised at the end because you might not have heard that little that little snippet in the original
Important piece
contract.
of
No,
information.
no, you're just focusing on that you're paying interest only while you're.
Well,
on
and that
whatever
you're
you
getting a house.
drew out.
Like we
Yeah.
get so excited about the house, we forget about the loan. We're talking to Mutual Mortgage today, Michael Ronchetti, Beth Rodriguez, and Guy Giles. We're going to have to take a quick break. We're brought to you by John L. Scott, Ashland, Medford, Mutual Mortgage, and the local Rogue Valley Association Realtors. Do not touch that dial. We will be right back. Hi, everybody. Welcome back to the Real Estate Show. We have Mutual Mortgage on. Today, they come on the show the first of every month. Guy Giles, Beth Rodriguez, and Michael Ronchetti. Thanks for being on the show, guys.
Thank you. I'm glad to be back.
Thanks for having us.
So before the break, we were talking about construction loans and assistance programs for down payments. And we were talking about the difference between USDA, which is a no money down, and how that's not really very practical anymore in our area. And then these construction loans that you guys are doing will actually work with manufactured homes and or drilling wells and putting in septics. I think that's quite remarkable.
It really is. It's a great program that historically had been, your local community banks that were the places that folks tended to go, and you had to wait in line. And now to have the ability, and that is a product that we do in-house. We don't broker it. So, you hear a lot of people talk about, well, yeah, but I send it to a broker. This is something that we use. And in many cases, it's our funds as well. So
that's nice.
It's a unique situation that you don't typically see with most lenders. And again, most folks have had to wait in line with their local community banks. And we're looking to bring it out. And really, again, a lot of it creates a lot of affordable housing opportunities for consumers getting in that are, don't have the income to maybe get some of the homes, but they can still get in the areas and get out there and buy homes that, quite frankly, when it comes to manufactured homes, are buying homes, as you mentioned earlier, energy efficient and well constructed. And if you have lots and things, and the other part is we can finance and put the buy of the lot in the program.
Oh, can you really? You can do the land purchase?
Yes. So some of the folks, some of the programs that on the traditional construction, you have to go out and get a lot loan, buy the lot, get the lot all done.
Yep.
We can actually use the purchase of the lot and put that in the financing of the loan itself, along with getting any permits and requirements done as well as.
Oh, that's huge.
Absolutely. So,
and as far as hold on, let me back up just for a second. I gotta grab this.
So on the construction side, can the buyers also do a VA version of that for the construction?
So the loans that we offer are conventional, and that would include if you're in high balance areas as well. I know Oregon currently does not have any high balance areas, which is shocking.
What's a high balance?
High balance would be loan amounts that go over your traditional conventional loan limits. That said, we do it in conventional, FHA, VA, and USDA. So if you happen to fall under a USDA area, we can do that same construction program. And effectively, the loan is based on the standard guidelines for FHA, VA. So a VA construction loan is effectively 100% loan.
Those are great.
USDA. And it's a great way to I love that product because our veterans deserve to be able to get into a home and potentially have no money out of pocket.
And a lot of them don't know that. So we should make a thing. Now, I know we wanted to talk a little bit about first time home buyers, and then you've got some special buy down and other programs. We've got a little bit, 5 minutes left. What do you want to talk about for first time home buyers?
So the great thing that we're seeing right now, we mentioned earlier, was millennials are a big part of what we're going to be seeing. We're going to be seeing a lot of first-time home buyers coming into the market, and God bless them. Let's get them out there. And now's the time to jump in. The Fannie Mae, Freddie Mac, otherwise known as FHFA, the federal housing that oversees, they did away for first-time home buyers. They did away with loan level price adjustments, otherwise known as LLPAs. And what that has done is it's lowering the pricing for first-time home buyers to get into the marketplace and be able to buy and afford homes. So effectively, a rate for someone that's is buying a home again or has bought a home already within the last prior 3 years, my rate's going to be higher than someone coming in that's never owned a home prior to and coming in and buying their first home. And it's a great time for somebody to jump in, as we talked earlier, from just the standpoint of it's still that buyer's marketplace. There's still an ability to get some possible closing costs paid for. That may not be here 90 days from now if rates continue to go down, but it allows for more affordable housing to come into play for that first-time home buyer. So now's a great time to jump on things and be able to get lower pricing. And if you put that together with what we're seeing a lot of right now, which is 2-1 buy downs, where you can effectively get your rate bought down year one, it's 2% lower than where it's going to be currently, and then after 12 to 24 months, 1% lower. You take that with the adjustments that just came out from Fannie Mae and Freddie Mac. It's a great time for first-time home buyers to get out there and buy homes.
I've also recently had, and I apologize for a minute ago, I was trying to silence my phone. I am bound and determined for that not to happen again. But I actually had 3 different times lately where people are going in, they're getting sellers concessions, because everybody thinks, that, hey, the market, I missed out. It was 6 months ago when everybody was bidding up $30,000, $40,000. Well, just because there's not a frenzy like that right now doesn't make it not a good time to buy. We've had 3 in the last month that they came in, they asked the seller, for something. The seller was happy to give it so that they could move on with their next project. And then we ended up buying down their rate with that. And then their appraisal came in high. So I think $15,000 high. So, we really haven't corrected like that, but the fear of God is a little bit in some of the sellers right now. So it's working out for the buyers. And I do think it is a good time to be talking to us. Rates have come down, about a percentage point from their highest where they were. And just because they're kind of, for lack of a better word, trickling down, doesn't mean that they're not coming down. And that is going to be the overall trend for later. So, it's like, I'm just a huge proponent of working with a good real estate agent, because I don't know that trying to do this all yourself would necessarily yield you a house that appraised for more than value. But come in and get ready. And if right now is not the right time, it might not be next, or it might be next month when that house pops up. But if you're in here, we've got you fully underwritten, ready to go. We're having a lot of them close in 9 days if they need to, and that could be the difference also in you getting the house.
Wow, that's exciting.
Being able to bargain for it. So we're here, and we're busy, but we have plenty of bandwidth to be able to take care of people. And I really don't know anybody around here that's beating us on rates and fees. So shop us. I will.
Yep.
Look you
Come
right in
in
the eye
and
if I'm getting beat.
talk to Mutual Mortgage and find out what you can do in your next real estate step. Well, it's unfortunate, but we're out of time again. So Michael Ronchetti, Giles Beth Rodriguez, let's have you on again, and let's have you on again soon. We still have lots and lots of first-time homebuyer stuff to talk about. There's a lot of construction conversation we didn't get to have, but you guys are great. Guy, 10 seconds. How do people get a hold of you?
Just give me a call on my cell phone. It's 541-944-6987, or G Giles at Mutual Mortgage. And we have Beth here too, that's completely fluent in Spanish for your people.
Thanks, guys. Have a beautiful weekend. See you next time.
You as well. Take care.